Assalamu alaikum friends, welcome to today's topic. Today's standard is IFRS 15 revenue, the much awaited lecture. I'm sure that most of you have been waiting for this revenue. I've got many requests demanding this video on IFRS 15 because most of the students were struggling with the revenue recognition and all. And also it's one of the important standard, right? IFRS 15. So let us go through IFRS 15. There are three parts to this. This is the first part of video, and here we are going to go through the 5 stages to recognize revenue. Second part will be discussing other issues for revenue, and third will be I will be solving all the questions. So for revenue, there are 5-step approach to revenue recognition. This video will be focusing on it. And second part will be focusing on the contract cost, the presentation in the statement of financial position, and the disclosure. So we are going through these 4 things. So let us start with IFRS 15, revenue. We all know what is revenue. It is an income which you are expected to get in the normal trading activities, right? Or it is known as operating activity. And revenue is presented in the statement of profit and loss should not include proceeds from the sale of non-current assets or sales tax. Okay? The revenue which is there, they do not include the proceeds which you get from selling of your non-current asset. Not those revenue, only those revenue which is from your normal trading or operating activities. Because the process which you get from selling a non-current asset, they are known as investing activities. They are not your operating activity or even the sales tax. So let us see an investor perspective. An entity's revenue figure is arguably the most important factor to consider when assessing its financial performance. That's why there is a separate standard on revenue recognition. This is one of the area where what do I say? The entities they manipulate the figure to show that they are performing well, right? And trust me, it happens. It happens. That's why there's a separate standard on revenue recognition, when to recognize and how to recognize. Okay, because revenue is the most important, one of the important factor, you can say, financial performance. So as a performance metric, revenue is understood by user financial statements. Revenue is used when assessing the market share and also form the base of many key financial statement ratios such as gross profit margin is based on that revenue. Okay, before we had IS 18 dealing with old revenue recognition. Okay, because this was criticized heavily, so they have come up with IFRS 15, a new standard. Okay, because it was having so much of it was not simple compared to IFRS 15, and also guidance was not there. There was so much of lack of guidance in many key areas. So that's why they have changed to IFRS 15. But this they will not ask you IS 18, so don't worry. It is just for some of you who wants to understand how why it was changed, because there were some issues with it. So they have came up with IFRS 15. Because IS 18 deals with only simple transactions, but we know that revenue recognition also, the transactions are not simple all the time in the organization. Sometimes the transactions might be very complex. So IFRS 15 is updated to reflect an increase in complex transactions. Okay. So what do? They developed IFRS 15, contracts with customers. Okay. So now let us see. You must have studied this earlier, right? But SBR will look at more complicated scenarios. And also revenue recognition is a key audit risk, and it also features in AAA. So this IFRS 15 is very important even for your AAA as well. So I will go slowly and make sure that you try to grasp the understanding of the standard. Let us start with the 5-step process immediately. So these are the 5 steps and it is in order. Okay. And we are going to go in detail in all of the 5. Okay. How to identify the contract, then the second step, third step, fourth step, fifth step. We are going to go in detail in all those 5. First of all, identify the contract. You need to identify that there's a contract. Second, you have to identify the separate performance obligation within a contract. Separate performance obligation means what needs to be done within a contract. Okay, they will give you what are the performance obligations. Third, transaction price. What is the transaction price? Fourth, transaction price to the performance obligation in the contract. Fifth, recognize revenue when or as a performance obligation is satisfied. So whenever you satisfy performance obligation, you recognize revenue, right? The following illustration will help you to gain an understanding of the basic principles of IFRS 15 revenue recognition model. Okay, let us go through this 5 step. This illustration one will help you to understand. Even though this example is much easy, simple. So on 1st December 2001, Wade receives an order from a customer for a computer as well as 12 months of technical support. One is the computer, the other one is technical support. Okay. Wade delivers the computer and transfers his legal title to the customer on the same day. So he delivers the computer and transfers the legal title to the customer on the same day. Transfers the legal title also. The customer paid 420 upfront. If sold individually, the selling price of the computer is 300. The selling price of the technical support is 120. So there are two performance obligation if you can identify. One is the computer, the other one is the technical support. Okay. But if we are solving individually, okay, then computer is 300 and technical support is 120. That's how you are getting 420 because it comes as a package, you know. Apply the 5 stages of revenue recognition to determine how much revenue we should recognize in the year ended. Whether it's 420, whether it's 300, whether it's 120, how much. Okay, and this is on 1st of December 2001. But the and year end is 31st December 2001. That means only 1 month you can recognize the revenue. But the technical support, if you see, it is the 12 months of technical support. Okay, so let's see how we are going to recognize the revenue here. All the steps. First one is identify the contract. Is there a contract? Yes. There is an agreement between Beta and his customers for the provision of goods and services. Are there separate performance obligation? Yes, there are two. One is supply of computer, the other one is supply of technical support. Transaction price was 420. And how do you separate it? 300 for computer, 120 for technical support. And recognize revenue when you satisfy. See, control over the computer has been passed to the customer, so the full revenue of 300 allocated to the supply of customer should be recognized. You see, this 300 should be fully recognized as revenue because control of the computer passed to the customer. What about the technical support? It is provided over time. Over time is over the 12 months. There are two things in revenue recognition that you need to understand. Sometimes it is at a point in time, sometimes over the time. For example, computer, you are selling at a point in time. Today you are selling the computer to the customer, you are passing the control, so you recognize the revenue. But technical support is not like that. Technical support is not like one time you are giving today, that's it. No, technical support over the 12 months you are giving the technical support. So it should be spread over the 12 months. The revenue. You understanding? It's like a depreciation. So the revenue allocated, they should be recognized over time. You have to recognize the revenue. So in the year end 31st December, the revenue of out of 120 you only have to take for the 1 month because that 120 is over 12 months. So only revenue of 10 you will recognize. Okay. In the SBR exam is unlikely to require you to apply all 5 steps to transaction. Exam questions will most likely focus on one or two of the steps. Remember this, please. It's only one or two steps in the exam that you might need to go through. They will never ask you that apply all the 5 steps to recognize revenue. Maybe in financial reporting, but not in SBR exam. More marks are in fact for the application of the relevant steps rather than the knowledge part. So now let us go in detail. Let us go in detail to step 1. Now it's in more detail. Identify the contract. So they say the contract is an agreement between two parties that creates rights and obligation. There should be a right and obligation. Someone has the right to receive the cash, the transaction price. Someone is obliged to pay that. Okay, so contract does not need to be written. Yes, it's not necessary that the country should be, a contract should be written. It could be verbal also. But it's good always. It's better that you write it down. That's what everyone suggests, right? An entity can only account for a revenue from a contract if it meets the following criteria. It has to meet this criteria for it to say that there's a contract. If they want to recognize the revenue from a contract. Parties have approved the contract and each party's rights can be identified. Party should approve the contract. Both the parties. If one party approved, the other party didn't approve, you cannot recognize revenue. right? And rights also identified. You know what is the right of each party. It is identified. Payment terms can be identified. Even the payment terms is very clear. Contract has commercial substance. There's some commercial substance to the contract. It's not something that there is like you're giving charity or something or price below the market price. No. Okay, it is probable that the entity will be paid. Probability is there that the entity will be paid. Let us go through an example. For each one, we have an example, don't worry, to make it more clear for you before we go to step 2. So, as at year end of 31st December 2001, on 30th September 2001, Luna signed a contract with a customer to provide them with an asset of 31st December 2001. So, control over the asset passed to the customer on which date? 31st December. The customer will pay a 1 million on 30th June 2002. That comes after 6 months. By 31st December 2001, as a result of the changes in the economic climate, Alona did not believe it was probable that it would collect the consideration that it was entitled to, right? Because he thinks that condition changed, so they are not, the probability is less that they will collect the consideration that they were entitled to. Therefore, the contract cannot be accounted for and no revenue should be recognized. You see, because it is not probable that they will collect the cash. The point here, it is probable that the entity will not be paid. Therefore, the contract cannot be accounted for and no revenue should be recognized. You cannot recognize the revenue. You understanding? Now let us go to step 2. Identify the separate performance obligation within a contract. So performance obligations. They are promises to transfer distinct goods or services to a customer. Some contains more than one performance obligation. We saw in the example before. Computer and the technical support. There were two performance obligations. Sometimes it's just one. Sometimes it could be three also. You need to identify that. For example, so they are giving examples where it's more than one performance obligation. An entity may enter into a contract with a customer to sell a car, which includes 1 year's free servicing and maintenance also. So the car is one performance obligation. Free servicing and maintenance for 1 year is another performance obligation. Two performance obligations are there. An entity might enter into a contract with a customer to provide 5 lecture as well as to provide a textbook on the first day of the course. So 5 lecture is one performance obligation. Textbook is another uh, performance obligation. Distinct performance obligations within a contract must be identified. The distinct performance obligations. A promised good or service is distinct if the customer can benefit from the good or service on his own or by using resources that are readily available, and the promise is to provide the good or services separately identifiable from the other contractual promises. So we'll see the example of it. Identifying the performance obligation. Construction of a school. Startling entered into a contract to build a school for one of his customers. To fulfill the contract, Startling must provide various services such as cleaning the site, laying foundations, procuring the materials, construction, wiring of building, installation of equipment, and decoration. The customer can benefit from each of these services individually. You see, you have to identify for each of this clearing site, laying foundation, they can benefit individually also. Evidenced by the fact that these services should be purchased separately from a range of entities. Right? How is it evidenced that individually customer can benefit from the services? Because you are giving each one, the roles are separated between different people. Not one person is doing everything. One person will be clearing the site. The other one will be to build a school. Build a school is one thing, but in that there are so many other things which you need to do. One is clearing the site. You are giving the contract to clearing the site to someone else. You are giving the contract to lay foundation to someone else. Materials will be bought by someone else. Wiring will be done by someone else. Equipment will be installed by some party. So individually, you can benefit from this. It is purchased from the range of entities. You are using different entities to do all this task to build a school, right? So, however, the services are not separately identifiable because Sterling has been contracted to significantly integrate them into an identified output school. Yes, they are not identified separately. For example, as a standalone, you cannot benefit. For example, if you're wiring of the building, you just wire the building and keep as it is. What is the benefit? You should do other things also with it. You need the help of other things with the wiring. Just wiring of the building will not give you any benefit. You have to do installation of equipment. All everything is integrated. They have to be done together. Then only that wiring of the building will be helpful. You see, so they are not independent. You cannot separate them from one another. They all are used to build one thing only, which is school. School is identified. It's an output. School. So, as such, Sterling accounts for all of the promised services as a single performance obligation. So, even though it's clearing the site, laying foundation, procuring the material, they are not separate performance obligation. They are known as one performance obligation only. You understanding? Not in the previous one we saw a computer and a technical support. There are two separate performance obligation. Because if you give a computer, separate benefit is there. If you can give if you don't give the computer, you can just give the technical support on its own also. That will be beneficial. You see. So it's not compulsory that only if you give a computer only you can give technical support. Technical support as a standalone also you can give provide to the customer and you can get benefit. That's why there were two performance obligations. But in this case, you see there are five or six things to do: laying foundation, procuring the materials, but all are to build school. They, if you do it singly, individually, they will not benefit you. If they are done together, integrated, and then a school is built, then only they will give you a benefit. That's why they are known as they are only one performance obligation. Okay. Principal and agents. They must decide the nature of each performance obligation. Okay. So to provide the specified good or service itself, okay, that means you are the one, okay, you are selling the goods and services on your own. You are the principal. But if you are telling someone else to buy, sell that goods and services on your behalf, then he's an agent for you. You're hiring an agent to do that. Okay, you are arranging another party to provide the good or services. It is an agent. So an entity is the principal if it controls the good or service before it is transferred to the buyer. If the entity is an agent, revenue is recognized based on the fee it is entitled to. Why this principal agent comes here in the revenue recognition? See, because not every time you sell directly to your customer. Sometimes you hire people to do it for you. That in that case, the revenue which you recognize will be different. The revenue which your agent recognize will be different, right? That's why this principal agent is there. The medium has changed the way you sell to the customer. That's why it is there in the revenue recognition. So if the entity is the principal, if it controls the goods or before it is transferred to the buyer, that means you are the one who has the control. You are directly selling to your customer. Then you are known as the principal. But if you're hiring someone else, okay, then that entity is an agent. Okay, and how does agent recognize revenue? Revenue is recognized based on the fee it is entitled to. See, when you are giving an agent, whatever the revenue they are getting for you, that is your revenue. But whatever the agent, you are giving them a fee for doing that, right? They will take a commission or a charge on it. Let's say 10% of your revenue or 5%, it does not matter. But what matters is that fee is their revenue. That is their only revenue. That fee what you are giving to them, your agent. So they will recognize that fee as their revenue, the agent entity. Understanding? What about warranties? See, with revenue comes warranties and all those things. When you go to the shop and all, warranties and all. So how do you recognize it? Because all these are under performance obligation. It comes under performance obligation. That's why it's there. Okay, we are still in step 2. Okay, what was step 2? Identify separate performance obligation within a contract. So there are separate performance obligations. So one of the performance obligation could be warranties also, right? Sometimes you see when you sell a good with it comes a warranties also. So that warranty is a performance obligation. And if it's a principal agent, then that fee. Okay. So most of the time, a warranty is assurance that the product will function as intended. If this is the case, then the warranty will be accorded for in accordance with IS 37. But you see, warranty is not according used with IFRS 15. It is accorded with IS 737. Why is it so? It is an assurance that the product will function. Most of the time it functions, right? It is something that it's going to happen in the future. You are giving it today, Okay, but today the product is functioning well, so the product might function well, the product might not function well tomorrow in the future, who knows what time. So that is something in the future, we are not sure. So today when you are recording it, it should be recorded as a provision. You're providing recording provisions on it. It could be an expense for you, right? The customer could come or the customer might not come. You're not sure, you're not certain. So you record under IS 37. It could be a contingent provision or contingent liability, contingent asset, IS 37, okay? So if the customer has the option to purchase the warranty separately, then it should be treated as a distinct performance obligation. If they have that option that they can purchase the warranty separately, the customer, then it is treated as a distinct performance obligation. Because warranties usually comes with a product, it does not come separately. But if you can purchase it separately, then it is a distinct performance obligation. This means that a portion of the transaction price must be allocated. Okay, that means you're using IFRS 5 on it. That portion for that portion which is bought separately. So the transaction price must be allocated to the warranties also. See step 4, we'll see in the step 4. In step 4, we have to divide it between different performance obligation, the transaction price. The transaction price will be one only. Out of that one transaction price, how it is divided along 2-3 performance obligations, we'll see in step 4. Same for warranties also. So let us go to step 3. This is one of the easiest. Transaction price. So IFRS 15 divides the transaction price with the amount of consideration the entity expects in exchange for satisfying the performance obligations. Here tax is excluded. Okay. Now, so when determining the transaction price, the following must be considered. Transaction price is not only in cash. It could be in many ways, the transactions, the consideration, variable consideration. We'll see in detail here what is variable consideration. It could be a significant financing component. It could be a non-cash consideration. It could be a consideration payable to a customer. So we'll go through each of these 4 to understand the meaning behind it. But all this needs to be determined when you are determining the transaction price. Okay, these 4 things comes. What is variable consideration? If a contract includes variable consideration, then an entity must estimate the amount it will be entitled to. See, sometimes a contract might say a variable consideration. So variable consideration is like you are estimating what are you entitled to. So IFRS 15 says this estimate can only be included in the transaction price. That means variable consideration can only be included in the transaction price if it is highly probable that a significant reversal in the amount of continue. Okay, I will highlight this. Probable that a significant reversal in the amount of cumulative revenue recognized will not occur when the uncertainty is resolved. What does it mean? Significant reversal in the amount of cumulative revenue recognized will not occur when the uncertainty is resolved. That means your revenue, what you have recognized, okay, the cumulative revenue which you have recognized will not change so much. It will not reverse. Okay, very significantly it will not reverse when that uncertainty is resolved, because you are estimating, no, estimation can be wrong also. So when you see that uncertainty is resolved, now you know which you are certain now. Uncertainty is not there anymore, and you see the revenue did not change so much. It did not reverse very significantly. Okay, then only you can include that variable consideration. There's a very high probability that it will not reverse. Then there is a high, definitely we'll do a question on this because it's hard to understand by the words. We'll do a question on it to understand this variable consideration part. Then only you add this variable consideration, okay, in the transaction price. Now, know that a product is sold with a right to return. See, when you are selling it, no one says that you cannot return this product. Right? So the right is also there. Customers can return it. So if then the consideration is variable. Okay, note that if the product is sold with the right to return it, then the consideration is variable. It might vary, right? The consideration. So the entity must estimate the variable consideration and decide whether or not to include it in the transaction price. They must estimate it and then they must decide whether to include it or whether to not include it in the transaction price. The refund liability should equal the consideration received or receivable that the entity does not expect to be entitled to. Okay, they should equal the consideration received or receivable that the entity does not expect it to be entitled to. Okay, so this should be something that the entity is not expected to receive. This consideration. This is known as refund liability. Financing. Financing is the next we were here in this list. Transaction price must be considered using the one is variable consideration. We went through that. Now it's just financing, then non-cash consideration, then consideration payable to a customer. So now let us go through the financing part. So in determining the transaction price, an entity must consider if the timing of the payments provide the customers or the entity with a financing benefit. You should see if they give a financing benefit, the timing of that payment, whether to the customer or whether to the entity. So IFRS 15 provides the following indications of a significant financing component. These are some indication that there's a significant financing component is there. Okay, the difference between the amount of the promised consideration and the cash selling price of the promised goods or services. The length of the time between the transfer of promised goods and services to the customer and the payment date. If there is a financing component, then the consideration receivable needs to be discounted to present value. Consideration receivable needs to be discounted to a present value using the rate of return which the customer borrows the money. Okay. And don't worry, definitely for each things we have questions, right? Which we'll be doing at the end. Non-cash consideration is measured at fair value. If the consideration is non-cash, measured at fair value. If the fair value of non-cash consideration cannot be reliably estimated reliably, then the transaction is measured using the standalone selling price of the good or service promised to the customer. Okay. How do you measure the transaction? Whatever is the standalone selling price of the good or service promised to the customer. That price only you take is a non-cash transaction. What about the consideration payable to a customer? If consideration is paid to a customer in exchange for a distinct good or services, then it should be accounted for as a purchase transaction. Okay, for example, you are paying to the customer for exchanging some goods or services. Okay, let's say they exchange some goods or services and then you need to pay back to the customer or you need to pay some amount. Then that should be accounted as a purchase transaction. Assuming that the consideration paid to a customer is not in exchange for a distinct good or service, an entity should account for it as a reduction of the transaction price. If it is not in exchange for distinct good or services, then that consideration paid to customer is reduced from the total transaction price. Okay, otherwise it is accounted for as a purchase transaction only. Mean to say that you have paid the customer, you have bought the goods and services from them. So purchase transaction. Understanding? What about allocate the transaction price is step 4. So the total transaction price should be allocated to each performance obligation. We know that. One price only they will give you that should be allocated with, among the uh, however much performance obligation is there. We don't know whether there could be 2 or 3 or just one in proportion to the standalone selling price. The best evidence of a standalone selling price is the observable price when the good or service is sold separately. Okay. If a standalone selling price is not directly observable, then it must be estimated. Observable input should be maximized wherever possible. If a customer is offered a discount for purchasing a bundle of goods and services, then the discount should be allocated across all performance obligations within the contract in proportion to their standalone selling prices. unless observable evidence suggests that this would be inaccurate. What does it mean? If the customers are offered a discount, that should be allocated across the all performance obligations, because you are purchasing a bundle of goods and services. You cannot say, okay, for this good there's a discount, for that good together you are buying that good and services bundle, and you are offering a discount. So that discount also should be allocated across all performance obligations, not just one. So we definitely have test understanding 6 for that, but we'll cover this later. Now let us go to the step 5, the main step, recognize revenue. So just okay, it's a big list. So revenue is recognized when or as the entity satisfies a performance obligation. Okay, we know that whenever they satisfy that, that means they promise that they will give this good, they sold it to the customer. They satisfy the performance obligation, then revenue is recognized. By transferring a promised good or service to customer, the good or service must have reached to the customer. It is transferred to the customer. Okay, an entity must determine a contract inception whether it satisfies the performance obligation over time or satisfy the performance obligation at a point in time. An entity must determine at contract inception. Inception means the moment you open the contract, you started the contract, the beginning of the contract. They must determine. Okay, what should they determine in the beginning of the contract? Whether it will satisfy the performance obligation over time or satisfy the performance obligation at a point in time. For example, that example we followed, computer and technical support. Computer was at a point in time. You are giving that control to the customer. That's it. Control went to uh, the computer went to the customer physically, right? What about the technical support? It was over 12 months. In that 1 year, anytime technical support the customer requires, they will give you. So it is at the contract, the day the contract was there, they told over 12 months. So it is over a period of time. The performance obligation will be satisfied. You understanding? So this should be determined from the beginning, whether it is over time or at a point in time. Please understand that there's a difference between these two in the recognition of revenue. That's why you should know whether over time or at a point in time. So they state that an entity satisfy a performance obligation over a time if one of the following criteria is met. If any one of it is met, it is over a period of time. Like technical support, okay? Number one, customer simultaneously receives and consumes the benefits and provided by the entity's performance as the entity performs. For example, technical support. The moment you are giving that technical support, customer is benefiting. Simultaneous is happening together. You are giving it at the same time, customer is benefiting. Second, entity's performance creates or enhances the asset. For example, work in progress that the customer controls as the asset is created or enhanced. Okay. So customer might have the control of the asset. Okay. They might have the computer with them, but whatever the technical support is required, you are giving it to them. Why? So that the performance increases of that asset. Okay. So in that case also it is over a period of time. Like technical support, you can keep one example in your mind and read the sentences. Entity's performance does not create an asset with an alternative use to the entity. And the entity has an enforceable right to payment for performance completed to date. Entity will be giving they will be receiving a payment for that technical support, right? They have the right to receive it, and they do not create an asset with alternative use. See that technical support. What is the use of that technical support? It is to enhance your performance of your computer or the experience of the user, the one who bought the computer, right? But you cannot use that technical support for some other users. You cannot use it like that. Then it is over a period of time. Okay. So if performance obligation is satisfied over a time, then revenue is recognized over time based on progress towards the satisfaction of that performance obligation. For example, you are building a build contract. You have a contract to build a building. So construction of a building is a very good example because it is built over a time. No house is built in one day. You don't go and give your building and hand over to your customer or client in a day. It takes years, 4 years, 5 years. Let's say 5 years. You have a contract to build a house for your client for 5 years. So how do you recognize revenue? At the end of 5 years? No. Every year you have to recognize revenue. So you recognize revenue based on the progress, based on how much you have completed the work. Let's say in the first year you have already completed 10%. So only 10% you recognize as the revenue of the performance obligation. And next year 20%, third year 40%. So like that revenue, the total amount which is given to you, it is spread over the 5 years. How much you have, however much you have completed, only you will recognize based on that percentage your revenue, understanding over that period. So based on progress towards the satisfaction of that means how much you have satisfied that performance obligation. You have made the building 10%, 20% of it, so 10% of it will be recorded as revenue in the first year, like that. Next, methods of measuring progress towards satisfaction of performance obligation include: how do you measure the progress over the time when you are seeing whether you satisfy the performance obligation or not? One is known as output method, the other one is known as input method. What is output method? You see the survey of performance. You take a survey of the performance or time elapsed. Okay, you see how much time they have taken, how much time went by. So based on that, you know by at least by now this much I've completed. Next, input method. You see the cost incurred as the proportion of total expected cost. You see what is the cost compared to the what you have expected, the total expected cost. So if progress cannot be reliably measured, then revenue can only be recognized up to the recoverable cost incurred. If you cannot measure the progress reliably, then how can you recognize revenue? Up to the recoverable cost incurred, whatever the cost you can recover, up to that much only revenue also you can recognize. You see, after everything we have a test understanding the questions. So we are definitely going to go through all. If a performance obligation is not satisfied over a time, what do? Then it is satisfied at a point in time. The entity must determine the point in time at which a customer obtains the control of a promised asset. Okay, they decide the time. One date will be given. They will say that at this date, customer controls the asset. So at that day, you recognize the revenue. At a point in time, is much simpler, right? We know that control is passed to the customer, so revenue is recognized. But the problem comes when it's over a period of time. That's why we went through over a period of time. So many things is there. We have to determine when it is over the time. We also have to see how are we going to measure the progress and all. But when it comes at a point in time, things are much simple. Now, an entity controls an asset if it can direct its use and obtain most of its remaining benefits. How do you say an entity controls an asset? If it can direct its use, if they can say that this is how they are going to use it, they have the power to say that this is how they are going to use it, and also the benefit. They are going to get the benefit, most of its or remaining benefit. Then an entity controls an asset. Control also includes the ability to prevent other entities from obtaining benefit from an asset. Yes, whatever the benefit is there from that asset, only you will get it. Other entities will not get benefit from it. Then that is known as control. That means you are having the control over the asset. They provide the following 5 indicators of the transfer of control. Now, these are the following 5 things that shows that the control transferred. The control has been transferred to the customer. You need to memorize this. You need to go through this. Entity has a present right to the payment for the asset. Okay. The entity has the present right to payment for the asset. So, since they have given that asset to the customer, entity will receive a payment for that transfer. So, they have the right to it, present right to payment. Customer has a legal title to the asset. Who has a legal title? Customer. Entity has transferred physical possession. Physically, it went to the customer. Customer has significant risk and reverse of ownership of asset. Now, the risk and the reward of that ownership of risk, that asset is with the customer. Entity will only receive the payment, that's it. Customer has accepted the asset. Yes, because sometimes what happens, customer might return that asset back to the entity. So until that is not accepted by the customer, it is not a transfer of control. So it is accepted by the So maybe in the exam, you might not be given this full 5 lists. Maybe one or two of these things might be given to you to show that there has been a transfer of control or not. So you might have to use this list. Then we have contract modifications. So from contract modification onwards, I will be covering it in part 2 of this video. So here in this video, let me summarize what I've discussed. I've discussed the 5 steps to recognize revenue, and we went in detail through the 5 steps. Starting from identify the contract, then we identify the performance obligation, then we determine the transaction price, then step 4 was we allocate the transaction price to the each separating performance obligation, and step 5 finally we recognize the revenue over time or at a point in time. Okay, then we went through the controlling factor. When do we say the control has passed to the customer? Then we went over the time, right? How to recognize it and all those things. Now, and also we went through some other issues such as warranties, principal agent, financing part, right? All those things. Now, next part, I'll be covering the remainder of this. So till then, take care.